Good morning, everyone. Welcome to this week's edition of Kenya Macroeconomic Review and our outlook for 2024. Good morning. Welcome to Sterling Digest. This is the third episode of our Macroeconomic Performance Review 2023 and our outlook for 2024. In this episode, we are going to discuss national accounts, Treasury Bills subscription, and bond trading performance. Starting with national accounts, our review of 2023 shows that there was a 7.3% increase in total revenue compared to the previous fiscal year. And then tax revenues for the previous fiscal year, that's the 2022-2023 fiscal year, was 2.04 trillion, which was equivalent to a 6.4% growth over the 2021-22 fiscal year, where tax revenues amounted to 1.92 trillion. Currently, the current year is the 2023-24 fiscal year, and we note that there's a 30% increase in the estimate for total revenue to 3.07 trillion shillings, and tax revenue at 2.6 trillion, which is 29% growth over the previous fiscal year. The fiscal deficit this year is estimated at 785 billion shillings. So starting with that, so far this year we've had an increase in receipts through debt of $941 and $210 million from the IMF and Aid and Development Bank respectively. In February, we also had receipts of about 230 billion shillings from the infrastructure bond. That is an infrastructure bond that set out to raise 70 billion shillings, but instead received 241 billion shillings. So that has significantly reduced the deficit that the government has for the current fiscal year. So Davis, there's talk about a second supplementary budget this year, and here talking about, because you can see from the figures, 30% growth in tax revenue, or 30% growth in total revenue, or 29% increase in tax revenue looks aggressive. And in our reports, we have consistently said the government is unlikely to achieve these aggressive targets. So our expectation is that in the next, or the revised supplementary budget, we're going to see a reduction in, obviously what should happen is a reduction in government spending estimates, and this will reduce the fiscal budget deficit. So any thoughts about national accounts and maybe touch on the expectations of the next supplementary budget?
Yeah, so just as you rightly said, we're in a situation whereby our estimates for revenue are way too aggressive and revenues are underperforming, tax collection more so. Now, in the next supplementary budget, what I would hope to see is expenditure coming down, because that's the only way to bridge that fiscal deficit, so at least reduce it to some degree. Because I'm sure they've been looking at the current receipts and have seen it's not feasible to keep on taxing the people, and those taxes are not having the impact that they should have on revenue growth. Because it's like you generate something called a Laffer curve. So a Laffer curve goes like this, then up, then down. So the marginal benefit of increasing taxes is not necessarily translating to higher revenue. That's just how it's basic as economics, like supply and demand sort of. So you can increase your prices of goods and services, but it will get to a point whereby people just won't buy because it becomes way too expensive. So in that same way, you can keep on taxing, but now businesses need to pass that on to customers. Stop buying particular goods, or you have income taxes going up to the extent that people stop buying particular things, it just doesn't affect the economy. So in the next supplementary budget, we would hope that expenditure would come down, and ideally that should be the main strategy, because that's the most sustainable strategy in my view, our view as a team. And so yes, that's what we would be expecting.
And what I've noticed in the past is that the government's, I would say, government's ability to reduce their recurrent spending is mainly constrained because of debt service and recurrent expenditure in terms of salaries and wages. So what has been the trend in the past is to reduce development expenditure. Is this something we expect to see in the next, in the supplementary budget?
I would believe so in my estimation, because it's been the trend that's been there over the past years, and it's the easiest to do, because they often mention that they can't reduce wages and the like because everything is political. You know, you need to make sure that the people who got you into power, in a sense, are the ones who will keep you in power. So you can't reduce that particular wage bill. There's this reluctancy to touch on recurrent expenditure, and
just sorry to interrupt, but just to add to that, you were seeing even doctors and nurses going on strike again, which means even we expect an increase in recurrent expenditure going forward, because these doctors are likely to be absorbed into the wage bill.
So it's likely that what we'll see next is just another reduction in development expenditure. I believe also development expenditure right now, the spend is quite low. It should be below 20% if I'm not mistaken. So it's likely to take a hit because it's the easiest to reduce. Though ideally what we should do is reduce recurrent expenditure and reduce wastage, corruption, etc.
Yes, so that is on national accounts. We'll move on to cover T-bill subscription. So we've seen relatively high T-bill subscription, with the 91-day getting the bulk of investor bids. And the trend is when interest rates are rising, investors tend to look on the shorter end of the yield curve and take the shortest tenor Treasury bill. That's the 91-day. In recent auctions, that is over the last few weeks, we've seen the 91-day T-bill subscription still high but reducing or declining, while subscriptions for the 364-day, which is the longest tenor Treasury bill, increasing. Does this mean that we're near the peak, or at the peak, or do you still see more headroom for interest rates to increase?
So on that one, we've had very interesting conversations with different people. So some people feel that interest rates have indeed peaked and are set to come down, and the view is that they haven't peaked on the basis of the fiscal deficit. So considering how wide our deficit is, our view is that the government will always keep on coming in for debt, and that means that investors can bid relatively aggressively and find acceptance in that particular regard. However, the view that we've been seeing of late is that, at least from a monetary policy perspective, the government is able to attract, let's say, foreign flows. So rates may have peaked on the basis of the monetary policy steps that they may have taken. So now there are those 2 points of view. Some people who feel that rates still have some way to go considering the fiscal deficit, albeit if we did have a supplementary budget that showed a reduction in expenditure and then they started implementing that by rejecting aggressive bidding, not being as accommodative and the like, because they don't really need the money in primary debt auctions, then we'd start seeing rates coming down quite steeply. That's one scenario. This other scenario is that rates have indeed peaked, and so people are now seeing that view and are saying, okay, since rates are peaking, it's good to lock in these rates, because we expect that rates will start coming down, and then ideally what would happen is that in the second half of the year, people would see, let's say, a reduction in the CBR and then start pricing lower. So you'd notice rates coming down quite quickly, especially on the short end of the curve. So those are the different viewpoints. So there's this general perception that yes, rates have indeed peaked, though assessing how fast they'll come down, that's anybody's guess.
Yes, and the release of banking results, most of the CEOs or CFOs are talking about, there seem to be this consensus view that rates are actually near or at the peak, and rates should come down in the second half of the year. Moving on to Treasury Bond Trading Activity. So last year, in terms of numbers, in terms of total bond turnover on the Nairobi Securities Exchange, was 644 billion, which was a decline of about 13.2% over the previous year, which was 742 billion turnover. This year so far we have seen slightly over 600. That means almost the entire turnover of 2023. What can you say about it? What's the reasons behind this, and what are expectations for the rest of the year?
Yeah, so it seems from where we are at that we'll likely do a record this year of possibly over $1 trillion. Last year, the main reason why people didn't trade on the secondary market is because since rates are rising, that means that the valuation of bonds on the secondary market tends to come down. So people don't want to recognize those losses by selling off their positions, that rather just hold. So bond turnover was down. But in this particular year, we had a very good IFB. So when that IFB came out, a lot of foreign capital came in. Then there were also a lot of people who missed out on that IFB. So trading activity on it was quite significant. And then we have this increasing perception, of course, that rates have indeed peaked. So people are more likely to trade in the secondary market when their bonds start trading at a premium. Because if you feel rates have peaked, demand for those bonds will likely pick up to start trading at a premium, and then turnover will pick up. So that's our expectation for this particular year. Bond turnover is likely to do a record of 1 trillion.
Yes, the IFB we are talking about is IFB 1 2024 8.5, which is given about 18.2%, which is fairly quite a good rate given the current interest rate levels, and also it's a tax-free bond. So looking back, in 2021 we had record bond turnover, which was 959 billion shillings. So if we cross $1 trillion, that would be the highest ever recorded. So any views about the general market? I know we're past, it's now in the second quarter of the year. The markets have surprised us. Two things have surprised us. The NSE has performed beyond our expectations. We're expecting negative performance to continue based on foreign sell-offs. I've seen foreign sell-offs remain quite high, or there have been net outflows, but we've also seen the return of retail and fund managers back to the NSE. Any expectations, at least since it's very volatile and difficult to call, maybe for this quarter?
Yeah, so I think we're waiting on the outcome of banks doing ex-dividend. So at that point in time, because a lot of the demand we've been seeing, or a lot of the rally we've been seeing, is largely retail investors coming into the market quite heavy. So now we're just waiting to see, is this people who are buying in for the long term, or are they just coming for dividends and the like, and then they sell off? So at least that will give us a better view, or a clearer view of how things are likely to evolve this year. Because I think the market has surprised everyone in that there was no catalyst to be seen per se. Yes, there's an undervaluation, but remember, bonds are trading at extreme highs, and there's that inverse correlation whereby if bond yields are quite high, then the return on equities, the required return is quite high, so valuation comes down. So we're just waiting to see if this demand is sustainable. As you've said, foreigners remain net sellers of it. We've had some big foreign interest has come in. Ideally, what would drive our market up is if global interest rates start coming down, and then local interest rates start coming down. So at the point at which there's that perception that global rates are set to come down quite quickly, local rates as well, then more capital will flow into the equities market, because at that point it means that the opportunity cost is not so high. Yeah, but still there are a lot of attractive counters, especially for longer term investors.
The latest indication, if you look at trading performance over the last 2 to 3 days, is that prices have stabilized. and retail investors are profit taking. Market has done close to slightly over 25%, about 20 to 25%. So yes, I think it's still soon to call, and we could see movements in either direction. The other thing to talk about is performance of the shilling. I just checked today, it's 127 shillings to a dollar. None would have called this at the beginning of the year when we were trading towards 160 or 170. Your thoughts on that?
Yes, I think sentiment remains quite positive. From the conversations we had with banks, it's that importers haven't yet stepped in, because importers feel that there's still some room to go. They can still save some money, just waiting for the shilling to appreciate more. Then now they step in. So at that point, remember, fundamentally as a country, we're not structured for a strong shilling, because we're net importers. Ideally, if we were strong exporters, we would have a strong shilling, and fundamental to play out over a long period of time, not a shorter period as has been happening. That shows you that this trend is more of on sentiment, not necessarily fundamentals. So eventually, sentiment, it's something that's normally coined. I'm just not remembering it correctly. So like in the short run, let's say something like the stock market is a what? Trading machine or sentiment machine. Then in the long run, fundamentals are what are weighed. So yeah, I've really butchered that phrase, but basically what it's arguing is that in the short run, sentiment is what matters. So good news, bad news. Then in the long run becomes fundamental. So eventually importers will have to step in, and then that would lead to depreciation. But when that will happen, no one knows, because sentiment can last for a very long time.
The last time we were at these levels, US dollar Kenya shilling was March 2023. So as much as 2023 was a difficult year, 2024 was expected to be a difficult year, but so far it surprised a lot of investors. It's not been as bad a year as the previous year. The shilling has strengthened, the NSE is performing fairly well. Interest rates, for those who believe in fixed income, the interest rates still remain relatively high. So return on investment has been good. That's it for a review of Sterling Digest of our macroeconomic report in this edition of Sterling Digest. Until the next episode next week, have a good week.